You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. My name is Brady. I'm glad to be joined by the CEO of Silverwood, Alex Shartsis. How are you, Alex?
Great. Thanks for having me.
Yeah, excited to chat with you. I know you advise a lot of founders on both go-to-market and sort of growth, but also as founders head towards liquidity, maybe M&A transactions. Excited to have you on to hear your perspective, because I know that you have a wide range of experience advising founders, advising companies, and also building a lot of products of your own.
Yeah, I'm super excited to be here. I think QSBS is one of those topics people just don't know nearly enough about because it has such a big impact.
Yeah, let's start with like maybe your day-to-day, because I know you split your time in a couple of different areas, but sort of the main positioning, at least as you come to our podcast, is as an advisor to founders and sort of your consulting business. Why don't you tell us a little bit about your day-to-day and who you work with, what types of companies, what types of founders you work with, and what stage of growth you feel like you specialize most in?
Yeah, great place to start. So I started Silverwood a few years ago to basically turn what I was doing with most of my time into a a more tax advantage structure, I guess.
Yeah.
But so I work with founders on go-to-market and M&A and a bit of strategy. So for example, yesterday I was working on acquiring companies with one of my clients. So they're in the climate space. They're looking to grow. Organic growth is difficult in that market right now. And so their board brought me in to help them find companies, which is a good time to be buying. All the reasons that make it hard to grow are great times to be a buyer. So I'm helping the founder find companies and acquire companies to trigger some inorganic growth. And then this morning, spent time with another founder who's looking at an M&A exit, and he's starting to think through that process. I've been working with him for years on growth and go to market. We've gotten to a point where it seems like a good option. And so we're beginning to strategize that. The other thing I do, which you mentioned, is I do run an AI company called Skip, SKYP.ai. And that came out of my work with founders. A lot of founders need to do outbound. And I found myself eventually like either recommending agencies or starting my own agency to help them with that outbound, because it's a lot of work. People don't like doing it. They don't do a good job. And we've basically taken AI and do that for founders using AI and give them the tools to run outbound, which actually, it's funny. We have a couple people using it to do fundraisers. So they're using Skip to reach out to investors to raise their Series A. Fully intend to use Skip if I'm doing outbound around an M&A event. Like you can use it for that. But anyway, there's a lot of cool stuff going on in AI, and it makes me think. I've been thinking about QSBS in that context as well. So that we could touch on that if you want as well.
Yeah, like I know your background is super diverse. You worked with a lot of different companies in different sectors and in different capacities. Your go-to-market hat versus your sort of M&A advising and help with that motion hat, which of those feels most like natural to your skill set and where you've been in the past?
Yeah, it's funny. I think I really enjoy M&A. I started an AI company back in 2013, the end of 2013, called Perfect Price. And we were so rookie that we incorporated like December 15th, right? Instead of waiting 15 days and, not paying taxes for the first year. It was, anyway, we were in a rush to catch an investor check, but way back then, it was a long journey. At the end of it, I ran a process to sell it. And I looked up at the end and I was like, wow, I had more fun during that process in a distressed sale than I had like the other 6 years of building this business. Like that was that like the M&A process is what got me super excited. It's just, I like doing deals. I like negotiating, and all those things kind of came together. There's a lot of aspects of that with go to market, where, you're setting your pricing, you're figuring out how to manage your pricing. That's a lot of what I work on with companies, is not charging enough or having a pricing structure that isn't really driving the business forward in the way that it could be. And so that stuff is also really fun. I think really, to me, like, we're with the, handful of exceptions that are going to go public, most people are in this for an M&A outcome. And to get an M&A outcome, the best way to do that is to be great at go to market, right? That's building a real business with revenue growth, that's profitable. Like, that's the path to exit for most people. You read about TechCrunch, people getting lucky all the time, but like, that's not the strategy. The strategy is build a great business, and you don't need to get lucky. Like, the luck will find you. And so that's why I think they complement each other really well, because if I'm working with a company that wants to do an M&A transaction, but needs to get their house in order from a go-to-market standpoint, I have the tools in the toolkit to do that. And then if I've been working with a company like the one I was talking to this morning for a long time, and they get to a point where it's time, they're ready to do M&A, like, they don't have to go find somebody else to know the business. I can step in and help them run that process, or hire bankers or whatever.
Yeah, it's hard to like get lucky with an idea, grow based on kind of momentum and PR, and then have to reverse engineer a good business because you realize you want to sell the thing, and it doesn't have the right metrics, doesn't have the right growth. Like, so
you didn't have to, right? I mean, like, if this were 4 or 5 years ago, right, 2020, 2021, like, you could get a great outcome with a terrible business. I mean, look at, I think it was Instacart. I may be confusing Instacart and DoorDash, but like, it was losing $15 per order, right? Like, every order was costing it $14 or $15, and they didn't even know. Like, the CFO showed up and he's like, "What do you mean we're losing $14 an order, $15 an order?" Right? And like, the controller knew, but nobody else seemed to care because they had $2 billion in the bank, and more was being wired every 6 months. I think it'll be interesting to see what happens with these AI companies, because a lot of them are operating at pretty significant losses on a unit basis. And so I heard that, for example, Claude or Anthropic had one of its API users was basically batching it was running its API calls in such a way so that it was costing Claude $10,000 a month, even though they were on the $200 a month plan, because there was like a 5-hour cap. So it's like, oh, you can spend your credits every 5 hours. And so they would show up every 5 hours and like blow the doors off. And so Claude Anthropic changed it to a weekly cap instead of an hourly cap. But, they were losing, $8,800 every month on this one client because of the way their pricing was structured. And it didn't matter because they've got billions of dollars in the bank. So I think that right now in the current M&A market, I mean, we've looked at companies and it's like, look, if you're losing $1 million a month, like, I don't care. Like, I'm not going to pay $20 million and then another $12 million a year in operating costs to hire your team. Like, you got to get rid of people, make it a well-run business, and then we could talk. So I think that's just the new reality.
Yeah, it feels like with with the monetization, massive ad networks, you think of Google, you think of all the social media platforms who can just kind of layer on advertising to eyeballs and audience. That spills over into a lot of other industries where, how many users do you have? How many impressions? How many, this? And I think folks just assume that you can monetize that easily versus kind of starting at ground zero with a paying customer, a great business, cash flow positive, versus like, okay, well, we have these 5 million, active users, whatever model or metric it is. And now we're going to retrofit on some kind of, economic model that makes sense. So because I heard recently, I think it was Sam Altman was talking about they're considering the pathway to add ads into ChatGPT, which you would assume that some product has that eventually, but it's just funny that, okay, yeah, now that you're massive, it's like, okay, let's turn on revenue.
Right. Well, that's the playbook. I mean, this has been the playbook for a long time. And it's going to be the playbook for the AI companies. You know, you build the consumer adoption, you build your moat, you get your user base, and then you monetize the user base. They were interesting in that they started with the $20 a month plan. You know, the idea of like, I mean, Facebook, it was floated at Facebook a long time ago and they never did it. But
yeah, I mean, that $20 a month actually, you know, to that point was one of the quickest purchases I've ever made on like a recurring subscription outside of Netflix. I was like, this is a complete no-brainer to do. And so, I'm not sure what the number is that I would pay a month at this point. I mean, we use it so much in our business. And then honestly, I showed it to my wife, and now I don't think she touches Google. We use it at, personal life so much, but this is not an AI podcast. I want to. So we deal with a lot of founders who are at the point where they're looking to sell their business. Sometimes they're just getting some liquidity, like they're selling secondary or they're raising a funding round, and there's a carve out in the deal where they're getting some liquidity. When you start working with founders who want to approach M&A, want to start shopping their company around, or want to explore what that's like, what are give me situations you run into on either side where a founder is really well set up, or a founder is not so well set up to enter into that stage of their company's life?
Yeah, I mean, so obviously, like with QSBS, you have to get things right at the outset. Right? You can't retroactively bolt on, or you have limited options to retroactively bolt on QSBS if you did something stupid when you incorporated. But I think that like now that I'm building Skip and, we're doing this and we know a lot more than we did before, we started as an LLC so that we can get it to an enterprise value where it's, under the cap, but still significant enough to maximize our QSBS potential. I think the number one thing people mess up is they focus on that and not building a business that's worth a lot of money, right? It's fine if you shelter $600 million in tax liability, but if you don't actually like sell the company for $600 million, then it doesn't really matter. So I think that's kind of the biggest mistake, is like you focus on the tax optimizations too early and at the expense of building a great business. But as you get later, I think the biggest mistake is similar. Like there's some founders I've seen who like drop everything to go set up their tax advantage structure, whether it's probably at that stage not QSBS. It might be some trust stuff or, some aspects of QSBS at the last minute, but it might also be something a little bit more shady. And that's first off, it distracts you from getting the deal closed. Second, it can be just a bad look in closing the deal, especially if you're using like something like an offshore trust or, one of the really more aggressive tax structures. And I've definitely seen that. If it wasn't the one thing that killed the deal, it was certainly like
didn't help.
A symptom, right? It was like something, it was one of the many things that founder did that resulted in a 9-figure deal not closing. Was that the one thing that killed it? I don't know. But it was definitely like one symptom among several that were just poor choices. And so I think that like in any transaction, you've still got to, the non-financial terms matter, but like there are a lot of things that matter, but like still close the deal, right? Like still, build the business if you're early, close the deal. Like if you end up paying more in taxes, like it's not the end of the world. There are things you can do later on, but don't slow down closing so that you can get your offshore trust set up. First off, it's too late. Second, you don't want the guy championing your deal to leave, right? Or the market to change or something to happen, and then you get nothing. So.
Yeah. And you mentioned earlier in the podcast about sort of your strategy around go-to-market as being, in your mind, the key lever for optimizing for sale later, which is right. Like you need to build a great business. A great business has a hot funnel and monetizes the funnel well, closes the funnel. How late in the process have you seen someone be able to get go-to-market right and then sort of optimize their outcome around that? Or is there sort of a point of no return where, hey, we were trying to build this thing to sell in 7 years, but we didn't really get go to market humming until year 5, and now we've kind of lost out on opportunity.
No, I mean, I think once you figure it out, you figure it out. Look at Clay, like they've been at it for 9 years or 8 years before they figured it out.
Finally
or
hits.
Bold.new, like they've been at it for similar, like 7, I think, years before they came up with Bold, right? And they were humming along at like $1 million in ARR and not really growing. And then, they, I don't know what's right now, 200 million. I mean, it's exponential. So I mean, it's never too late to find great product market fit. I think unless you run out of money, right? So if you're a venture backed business,
that's actually
right,
kind of trying to set up is
I think
right?
The downside is I don't know what Bolt and Clay's cap table look like, but like that's fine if you are frugal and you're able to retain ownership. But a lot of founders will look up, especially Y Combinator founders will look up, 3 years in, having raised a bunch of money on safes that now all really are very dilutive. 5-10 years ago, they weren't as dilutive, but now the post-money safe is very dilutive. And so, you end up with this like, wait a minute, what do you mean I only own 20% of my company? Like if you have 2 founders, the numbers are out from Carta. They came out a couple of weeks ago around dilution at different stages. And by Series B, investors own more than half the company. But by Series A, once you take into account the options pool, founders own less than half. And sort of the expected sort of middle of the road valuation. And like a lot of founders like, oh, I'm going to be better than that. It's like, no, you're not. Like on average, that's what you're going to be. There's as much chance that you're better than that than you are worse than that. So like counting on being better than that is not necessarily a winning strategy, especially if, as the question supposes, you haven't really figured out go-to-market fit. And so I think that like, it's fine if you're able to keep dilution in check and really stretch your runway and sort of run ramen profitable until you're able to figure out that go-to-market motion that really drives significant venture scale growth. But if you don't, and you end up going through your Series C, or if you're fortunate enough to be able to raise the Series C without having figured out your go-to-market, right? It's going to be really dilutive, and you're going to wake up and you're going to own 10, 15%. I mean, the Pandora founder CEO owned 3% when they went public. Like, I don't think anybody was like, oh, when I go public, I want to own 3% of my company. Like, it's still not a terrible outcome, but he would have Evan Williams made more money selling his company for peanuts to Google early on than the Pandora founder made from the IPO. So.
Yeah, you have to have in mind what your outcome is as early as possible and optimize around that with whatever your strategy ends up being. Like if you want to be bootstrapped and or if you want to raise 7 different rounds of venture funding, either it might be a viable outcome either direction, but you need to align your business strategy with those as well. You can't you can't lag the scale that venture expects with the with the dilution that you bring on. And
you asked what businesses go wrong. I mean, I think that like the biggest mistake is you do that. I mean, the Carta numbers were like the 99th percentile of Series B's was $2 billion valuation, right? Mm-hmm. They're like raising, I don't know, 100 or 200 on $2 billion. And it's like, that's great, except that's more than YouTube sold for. So, more than Instagram sold for. So like, would you rather just get the $2 billion and put like 1.6 of it in the bank? Because the other problem is like, if AI is slightly less hot next year, the year after, 4 years from now, and you're going to sell, like you might not get 2 billion, right? And now you've got lots of problems, right? Preferences and blocking rights and all sorts of other things that came with your amazing valuation that might make it really hard to sell for like 1 billion.
Right.
So I think that I assume those founders took money off the table. Like the Clay founders have taken money off the table in all the recent transactions. I think the last one, no money actually even went into the company. It was all secondary. But but you just want to be smart, right? You get these like insane valuations, and it sets a high watermark that if you're not taking money off the table, just becomes much more zero sum for you as a founder. I mean, I hope it keeps going, but like there's a non-zero chance that it doesn't. and you could, friends of mine, I think I can share their names. Like I know that both of the founders of Wheelhouse, which was Lyric for a minute, and they started a SaaS company, pivoted into running the assets and raised $120 million. And then the pandemic happened, and all of a sudden that business went away, and they were living in an underwater house to the tune of $120 million in liquidation preferences. And one of the founders was like, why would I work here? Like, my shares were worth $20 million 2 weeks ago. Now they're worth zero. They're going to be worth zero in almost any conceivable scenario. Like, I'm going to go do something else. Right. Yeah. So even though, you raise $120 million on a $500 million valuation, things change.
Is it the right or the wrong question when you raise those later rounds of funding and high valuations to just ask before you go into that process, like, hey, do we just sell here? I don't think.
I personally don't think so. But if you asked Mark Zuckerberg, you might have a different take on it. Like,
yeah,
to me, I think
a bad person or a bad outcome and a bad person maybe to compare.
Right. No, and I think like for me, like all of my experiences have been, I've hit a bunch of like singles, doubles, and triples. I've never hit a home run. And so like if you were, a person that's hit a bunch of home runs, you might feel differently about it. To me, I think, I don't know, a good friend of mine, like a serial angel investor, was working at this bootstrap company, and the founder got an offer for $10 million, and it was a bullshit company. Like they had revenue. It was a, ad network essentially. But he was like, if you don't sign this shit, I'm going to lock you in the trunk of the car and forge your signature. Like, this is a great deal. And if you don't take it, like it's not going to go well for you. I was going to say something you probably can't put on Spotify, but like, it's like, this is like this, like, think about your bank account with $8.5 million in it and look at it where it is now with like $40.32. Like,
sure,
take the $8 million, go start another company in a year, right? Like, why would you not take the money? And so if that's the case at 10 million, why wouldn't it be the case at 250? Right. And so, I think a lot of founders, especially Y Combinator founders, like they're in this echo chamber of like, I raised my round at $50 million pre, and I raised, they're the ones who probably raised the $100 million at a $2 billion valuation, right? And so it's like, oh, if I sold my company for 15 before I raised the Series A, like, I'm a failure, right? Like, you now are a millionaire, like, and you can apply to the next batch and do it again in a year. Like, you don't need to hit a grand slam in your first at bat or even your second at bat, right? Like get a base hit so you can stay in the majors and get another at bat versus swinging for the fences and striking out. So that's kind of I'm perhaps unique in that, but like Mark Schuster talks about this. One of the more prominent LA VCs, how his first company like got an offer for 150 million. Was like, no, Goldman Sachs invested. We're going to go public, right? Went to zero. His next company gets an offer for 40 and he immediately takes it. He's like, I'm not making that mistake twice. So.
Yeah, it's that. I mean, it's a lot easier to, like you said, hit a single and then your next time up, like really swing for the fences, because now you have $4 or $5 million in your bank account. You can actually seed maybe your new company with a little bit of money to start out with. You can be more strategic about the way that you raise. I cringe every time I see a founder, maybe it's on LinkedIn or somewhere, and in their bio, it's just, maybe there are 3 past companies, but the only thing they talk about is like how much they raised in those last companies.
Right. Yeah.
Like,
there are no points for raising money.
Yeah. I mean, it's an incredible accomplishment to raise any amount of money. It's a grind to raise capital. Especially in the venture world, and to raise, say, $100 million of capital is certainly a grind and an accomplishment. But for that to be held up as like some badge of honor in Silicon Valley, as like, this is what I did, is just a weird, a weird trophy. I'd rather take
it's a weird trophy. I mean, it's
$5 million outcome versus raise 100 million.
It is difficult. Like, I see stuff from like minority founders or women founders. Like, it's so hard to raise. It's fucking hard to raise for everybody. Like, I'm a white guy who went to an Ivy League school, and I got rejected hundreds of times. Like, with a PhD machine learning co-founder, like we had a lot more, like 100 times more VCs say no than say yes. So like, don't think that because you're a different skin color or you're a woman, it's harder to raise. And maybe it is, but it's really hard for everybody. And like, period. So raising it feels like an accomplishment because it is so hard, but it is not the end game. That's like making the playoffs. That's not winning the playoffs. It's not even winning a single game in the playoffs. And so I think that, you know, for Skip, for example, like we're very aggressively not raising money. Like, we want to run it through revenue generated by the company. At some point, if the company is doing well enough to justify raising and we had a use for the funds, we'd consider it. But like, we're bootstrapping because we've done this before and it's a distraction.
Yeah. To have to raise is the worst time to have to raise.
Right.
You know, you want to raise when it's strategic for your business and when it gets you to that next stage.
Yeah. And I think, I mean, that's a lot of the rounds we talked about, like Clay. I'm sure like people were banging down their door and they're like, well, we'd sell if you gave us this valuation. And they were like, okay, here you go. And so they're like, all right, well, you know, I guess we'll sell some then. So I think that, I mean, irony, especially, I remember joking with a friend back when SoftBank was on its buying spree. And I knew I was close to a couple of the companies and I was like, this company is terrible. Like, everything about it is it's a terrible business. Like, the management doesn't know what like, it was like, really, like, what do they see that I don't see? Cause I'm pretty deep here and I don't see any of this. And we realized it was like the best thing to do would be, the only way to short one of these companies is to be a founder. Like, that's the only way to short them is to sell shares to SoftBank. But that, you know, that the reality is a lot of these companies that are raising these huge valuations aren't going to work out. And that's fine. That's the game. But as a founder, like, that maybe isn't the game that you are best served by.
Yeah. Do you think we're going to see, or do you imagine that AI will really enable as much like non-technical founder building and bootstrapping from day one as people sort of intonate in the market right now? It's like, wow, now anyone can build software. Do you think that is on the five-year horizon? Do you think it's going to accelerate the bootstrap founder movement, or do you think it's going to be more of the same?
Yeah, I mean, my co-founder and I have this debate all the time. So I'm technical, but I haven't coded, you know, for pay ever. I guess that's not true. When I was like a kid, my parents paid me to do some stuff, but like, I, you know, did AP computer science as a sophomore, went to Dartmouth, studied computer science. Like, I'd be doing a disservice to a lot of great professors to say that I didn't know anything. But it's funny, like, Skip.ai is fully vibe coded. Like, I've coded all of it myself using Bolt and Cursor and other tools. My co-founder, who went to Cambridge and is technical and has like built a bunch of stuff, is constantly like, maybe we should move it over to Webflow or Framer or something else. And I'm like, that would be harder for me. Like, that would take me longer to like work in a template than it does to vibe code a new page. That said, like, you need to know what you're doing a little bit. Like, we just did a bunch of comparison pages for SEO, and like, you know, it's a little bit complicated and it took me half a day.
Mm-hmm.
My long way of saying, I think that it's easily a little bit overhyped. I think being semi-technical is required to get anything meaningful built. Like, yeah, could you launch a web page like easier than using Webflow or Wix or something? Like, yes, you can tell Bolt to build you a web page. It will build you a web page. Will the web page do what you want it to do? Probably not. Like, it'll be close. It'll look great. But it's probably not going to be exactly what you want it to do. And getting it to be exactly what you wanted it to do can be a real pain. So I think when you get into like more complicated things, like, oh, wouldn't it be great if my kid had a carpooling app so I could arrange carpools? Like, there are hard problems out there, and it's kind of hard to vibe code your way through them. That said, if you want to build a plugin to take stuff from your Gmail and put it somewhere else, like, yeah, you could do that in 10 minutes. Right? Like, there's a lot of stuff that's become super easy to build. So long way of saying, like, I think it's a little bit overhyped, but it's still real, right? Like, I think from a prototyping standpoint, there is absolutely no reason to ever build another prototype in any other format than code using AI, because you can easily build a really great front end, show it to customers, maybe go raise your Series Seed on that, right? Maybe even sign a couple customers, and then figure out how to do the back end once you hire somebody. That part of it's different. And then bringing it back a little bit to M&A, I think one of the old sort of truisms was that you can never like acquire a product without acquiring the team to run it. I don't know about that now. Like, I think you could load it into Cursor and be like, hey, we need to fix this bug, like find the bug. And Cursor can like look at and understand an entire code base. And so you could potentially see M&A where it's IP acquisitions, where it really is an IP acquisition and not just putting on a shelf, but you're actually moving the code base over and using it, but not bringing the team, which is an interesting potential change in the M&A environment.
Yeah, let's stay there here to end our conversation. Talk about M&A. Obviously, this is a QSBS oriented podcast, and we talk with a lot of folks who are in and around that space. Is that part of your role to sort of educate founders on like the full scope of their outcomes and opportunities, including some of the possible tax opportunities and other sort of strategic moves that they can make when they get to that stage? Or are you really just like, hey, let's see if we can find you some interest out in the market?
Both. I mean, it depends on the stage. So I don't do a lot of investing. I just invested in a company, and the founder hadn't heard of QSBS, and I was like, wait, what? Like, who are your lawyers, and why haven't they not told you? Turned out she was in the food space, and I don't know, retail food's the wrong word for it. Like restaurants, like there are things you have to do. It's one of the excluded categories. So that didn't come up because it shouldn't have come up. But I think yes, the short answer is like, yeah, I want to make sure that founders know kind of the broader corpus of things that they should be aware of. But basically, like I run a newsletter, which, I know you reach out, like you got called Seed to Sequoia. And it's really like, it's almost like letters to me 10, 15 years ago of like, shit, I wish I knew when I was a founder the first time, so that I would do things a little bit differently. And it's stuff like that, whether it's like, hey, this is how you set yourself up for QSBS treatment, or this is how you sell your company, right? This is what you need to be set up to sell a company, or this is how you build a pipeline. Like, some of it's pretty basic, some of it's pretty advanced, but it's all stuff that's like at different points in my career, I really wish someone I trusted had told me, because I think people get a lot of advice and not all of it is good advice. And so I definitely, like, some of the biggest problems my company experienced were 100% based on like what an advisor told me I absolutely had to do in that moment. Or a VC told me I absolutely had to do, and they were completely fucking wrong, but I didn't know better. So I listened to them. So.
Yeah, we talk about QSBS and tax optimization in general, but obviously QSBS is the most important one for founders, especially venture-backed companies, as it's real, like paying taxes is real dilution. Like, you think you own 30% of your company. Well, now you sell and you have a 25 to 35% tax bill. You didn't actually get 30%. You got 20 or whatever it ended up being. So yeah, I look at that kind of optimization as, it's another thing that's sitting on your cap table and taking value out of your pocket if you do have an outcome.
It's a good way to think about it. I hadn't thought about it that way, but yeah, it's like Uncle Sam.
Yeah, IRS is on your cap table.
Right. Yeah. Or it's 25%, I should say.
That's right. Yeah. So it's good to hear there are sort of advisors who aren't CPAs, aren't attorneys, but folks who are walking alongside founders who are caring about those things as well. I think that's important, by the way. Like, I'm not an attorney, I'm not a CPA, and I consider that a good thing. Like, I think that when you work with attorneys, like, they tend to focus. There's some great attorneys out there, don't get me wrong, but they they tend to like not want to have opinions on business terms. And I think attorneys are great in an M&A environment because they've seen a lot of deals. They can't tell you whose name was on them, but they can give you a sense for like what the market is, or whether to push back or not, or whether pushing back is normal.
But they're not going to have strong opinions about key terms like valuation or vesting or, retention, grants, et cetera. Even though they'll kind of know what the market is, they won't be able to advise you on what's best for you. And the same is true with accountants, almost worse, right? Like they again know what's out there, but they're not going to be helping you figure out how to justify your $1 million carve out or whatever it is that you feel like you want in your deal.
Yeah, a great service or database would be, or maybe it's just a chat bot where a founder can say, hey, I have this problem where I'm dealing with this situation. Who should I talk to? Or like, what type of person should I talk to? And it can tell you, you definitely need an attorney, or you for sure do not need an attorney. Talk to Alex or talk to some other.
Yeah, right. Yeah, no, if we could get it to send people to me,
it'll save people a lot of money.
I would pay to advertise for it. Yeah.
There you go. So, thanks a lot, Alex. We'll put a link and details for your Seed to Sequoia newsletter, which I think is a great read, a short and informative read that I've been getting in my inbox. So I appreciate coming on and joining. And thanks for sharing your insight.
Thanks for having me, Brady. It's great. I appreciate the work you guys do. I think it's important for founders to be smart about this stuff. And glad you do the podcast and glad you help people not pay taxes. So
yeah. Hey, I'll talk to you again in the future. All right. See you, Alex.
All right.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.